Okay, we'll continue with the cost of investing in mutual funds. Net asset value and effective load. The cost to initially purchase one share of a load fund or loaded mutual fund is the net asset value plus the front end load. So you're going to pay that fee on top of the net asset value. These loads can range from 0 to 8.5%. So the loads are designed to offset marketing expenses. Goes directly broker to the broker who sells the fund to the investor. I mentioned that previously. One other big point is the effective load is actually greater than the stated load. So which basically just means that the impact of the load is to the investor is greater than the actual stated amount. So we talked about mutual fund performance associated with loads and so forth, and discussed the fact that there's essentially no benefit to them, and the fact that it actually just reduces your return. So, fees and mutual funds returns, soft dollars. Soft dollars is research services, or represents an arrangement for research services between a broker and the investment company. The broker will provide these services free of charge in exchange for business. So what will happen is the mutual fund will agree to buy and sell some portion of their trades for the fund in exchange for these services. These are generally viewed negatively because the belief is that the fund should pay for these services out of their profits and not out of with investors' money. So, rate of return. This is essentially the same formula that we've seen before. Holding period yield. It's simply we're just using the net asset value at the end of the period minus the net asset value at the beginning of the period, plus any income and capital gains distribution. The difference here, and then we would divide by the beginning net asset value. The difference here with a mutual fund is that our income can come from different sources. It can come from dividends and capital gains distributions. We'll talk about this going forward a little more. The table 4.2 gives an example of an investment of $10,000 into three different funds, A, B, and C. Fund A is a no-load fund with a 0.5% expense ratio. Fund B is a loaded fund with a 1.5% expense ratio. Fund C is an 8% load fund with a 1% expense ratio. The gross return is assumed to be 12% on all funds. If we look at compare the growth of the funds over time, what happens is if you look across the top line, Fund C, that 8% came off the top. So as a result, that $10,000 investment was really only a $9,200 investment. So as a result, over time, when we incur growth, Fund C is going to lag behind. Over time, Fund C does catch up with Fund B, the higher expense ratio fund. However, the Fund A with the lower expense ratio ends up with a considerably larger amount of money over time, no matter what the investment horizon. General tax rules for mutual funds. Funds are not taxed if they're diversified and income is distributed to the shareholders. Investors are taxed on capital gains and dividend distributions. The turnover is the ratio of trading activity to the to the assets of the portfolio. This is a concern with mutual funds. The one of the problems with mutual funds is that you don't have control over your when you recognize gains and losses. Those are the purchase and sales that the mutual fund does within the fund are you're going to pay taxes based on the gains and losses of the fund during that period. So, as I just mentioned, portfolio turnover may invest. Portfolio turnover will affect investors' tax liability. Implications of fund turnover. Fund pays commission costs on portfolio purchase and sales. Those are charged against net asset value. If a fund with high turnover is going to have higher costs. Turnover rate is turnover rate is measured by annual total asset value bought or sold during the year divided by the average total asset value. We'll talk about exchange traded funds next.